Hey, it's Dr. J. Welcome students to chapter 6 of this course. I wanted to do another video lecture for you, of course, to go more into the specifics of chapter 6 being business formation, choosing the format that fits. Now, business ownership, which is what the first section talks about, goes a lot into sole proprietorships, partnerships, corporations, and general partnerships. And there's some distinctions between these different types of businesses. Okay, so with a sole proprietorship, you're basically working for yourself. You're responsible for all of transactions, ins, outs, researching regulations, anything that involves your business and what your business functions and mission statement is. It's on you as a sole proprietorship, okay? All right, in partnership, a partnership is a voluntary agreement under which two or more people act as co-owners of the business for profit. All right, now that could be, it can go from a sole proprietorship to a partnership. So, you know, businesses are fluid like that, with certain, you know, key aspects taken into consideration. So you can go from a sole proprietorship to a partnership, meaning that, you know, you were working for yourself and now you want to, you know, partner with your friend or your mom or brother or whatever, as far as that goes. But the good thing about that is it could be for profit. All right, so it's for profit, which is, you know, a win-win for both. Now you have to decide who owns more of the business, if that's one way you want to go about it. You also have to keep in mind, if you choose not to be partners anymore in the business, you know, who's going to take what percentage, who's going to buy who out, who's going to get certain clients or, you know, profit off of things that were done together jointly in the business partnership. So it's kind of important to think about those things. Even if you have a great relationship, it's just good to have a conversation about that if you're looking at going into a business partnership. All right? Corporation. So a corporation is a business entity created by filing a form known as the Articles of Incorporation. So remember we were talking about, in some chapters back, we were talking about FDIC and how it's basically the Federal Deposit Insurance Corporation, but it's a federal corporation, okay? So this is how this is functioning. It's functioning as a business entity on the behalf of the consumers, because they have to make sure the money's insured. So even though it's a federal corporation, it's still, you know, it's still treated as a corporation by the fact that it's insuring consumer monies with banks. All right. So limited liability. Now, limited liability is a little tricky when it comes to deciding what type of business you want to have. So the limited liability basically outlines the meaning of who's responsible and liable for what on behalf of the business or behalf of the customer. And then that leads us into limited liability companies, which is LLCs. So often, you know, instead of going into a sole proprietorship, you could always individually be a limited liability company as well. Okay. Some benefits of limited liability are you're not solely responsible or personally responsible for clients, you know, using certain things as far as your services if they're non-tangible. So, for instance, if you're a motivational speaker, okay, and you speak on behalf of motivating people to, you know, live their best life, well, then you could function under an LLC because it's not your personal responsibility if somebody doesn't take the tools of knowledge that you've given them to better their life and their life doesn't become better. So you're not personally responsible for the non-tangible tools that aren't being utilized by your client. All right. Okay. So then we get into total number of businesses from ownership and total net income from ownership. Now these two basically break down those exact things. It gives a overall of the total number of businesses from ownerships and net income of ownerships. So the net income, of course, of the corporation is going to be extremely more, especially if it's a corporation that is fairly popular in their supply and demand in the market. And then if you look over at the businesses ownership for sole proprietaries, there's a lot. There's a lot of people that, love going into the business for themselves, want to create a business for themselves. But if you look over at the net income, it's actually the lowest on the chart in comparison to partnerships and corporations. But that doesn't necessarily mean that small businesses aren't successful, because this nation was built on small businesses, and there's still thriving small businesses that really lead the way in certain markets. So it's really important that you understand your market, your consumer, what your supply and demand is, the equilibrium between the quality of your product versus the quantity of how many you can produce of your product. That's really important. And, create business plans. So it's really important to make a business plan, stick to it, revise it if you have to. Statistically, it's been shown that, banking industry, that's private corporations and institutions and businesses, but they actually have a 3-year plan of if a bank is going to succeed or fail. Okay, so just because you're working for yourself and you're not seeing any profit or any revenue come around within the first year or even year and a half does not mean that you're not going to be successful. Okay, all right, it just gives you time to hone in what your actual market is. All right, so some advantages and disappointments of sole proprietorships. Obviously, some advantages are you make your own hours, you're on your own schedule, you can network and do whatever you want with your company, and you are really the subject matter expert for your own company. Okay, I think that's really important to mention, which is not mentioned in the book. Some disadvantages are that it's, you have limited resources as far as financial resources. You may have limited inventory. It's a possibility. You have completely unlimited liability. So, whether the company is successful or fails is on you and what you put into it. But also, it's also a heavy workload. So I professionally recommend when I'm talking to clients that you start a business with something that you are extremely passionate about. You must have passion to be a business owner. Okay? Once you have your passion, it's not even going to feel like work. It's going to, feel like you've always been able to do this and you enjoy it and you actually look forward to it. All right? If it doesn't feel like, you're enjoying it, maybe you should revamp your business plan and re-strategize and see if, you may want to go a different route. All right. So we're going to go on to some advantages of general partnerships. So the book outlines the quality or the ability to pool financial resources, which is a big one, especially if you need capital and money to grow your business, which you do. Like I said before in the previous chapter, you need money to make money. All right. The ability to share responsibilities and capitalize on complementary skills, which is great because what you may be good at, somebody else may have other skills that you're not so good at. So that's a good thing. Possible tax advantages. There's tons of tax advantages when even going into your own business. I think I mentioned before the Small Business Administration. If you go to their website, there's always loans, grants, different monies that you may want to go ahead and resource there. And they also have great advice. They have free workshops. They have conferences you can go to. There's a ton of information about small business administration. Okay. All right. And then limited partnerships and limited liability partnerships is another partnership arrangement that is attractive to partners who want to limit their personal risk. Okay. Again, it's really popular among self-employed, people that conduct training or are working with non-tangible items versus like motivational speaking, just different things. But more than likely, it's a non-tangible good with limited liability. But, there are situations where there's limited liability on products. And it's, there's a little disclosure based on, your personal risk. You're using this item or you're obtaining this, particular product, and the company could be limited liability. All right. It's also really popular in construction. So I just wanted to mention that. All right. All right. So it goes into forming a C corporation as well as ownership of C corporations and the role of board of directors. So I'm going to let you go through the C corporations because it's pretty short and explanatory. But I did want to touch base on the difference between stockholders, stakeholders, and shareholders. Basically, it's all the same, but it depends on the amount of company or the business that they own. So, for instance, there's corporations and Fortune 500 companies that actually, upon you working there, you starting there, you get so much of the company, okay? Meaning that you have stock or stake into the company, so you are a part of the ownership of the company. And the mentality behind that is it's the thought that, well, if you have and own a piece of the company, then you're going to feel more apt to having, some kind of loyalty to the company or understanding how, ideas work or being more innovative. So that's really important. The role of board of directors. So there's the board of directors, okay, and they basically influence different policies, procedures. Sometimes they're the ones that fund the business. And it's really important to, if a corporation establishes a board of directors, that they have input on everything that happens as far as changes with the businesses, what happens, what doesn't happen, keeping up with rules and regulations, also getting advice on how to improve things, what to, cut off, budgetary reasons. They have a lot to do with what happens with the corporation or business. All right, so some advantages of C corporations are, of course, it's limited liability, the performance, ease of transfer of ownership, which is really great. Some disadvantages are the expense and complexity of the formation and operation, and also double taxation on earnings and additional taxes. So the IRS considers a C corporation to be a separate legal entity and taxes its earning accordingly. Then it's shown that the taxes of the two different items need to be taxed individually. So that's a huge disadvantage, especially when it comes down to what the corporation is actually doing and how much money is actually being funneled to the company, what's needed for capital, what's considered liabilities. So those need to be looked at as well. All right. Okay, we're going to go to the limited liability company, the new kid on the block. All right. So it's been just within the last, 10, 15 years that limited liability has even been popular because, consumers, you may have heard about, the incident at the restaurants where hot coffee was spilled on somebody and the company had to decide whether it was their fault or the person's fault because the caution symbol around the cup was not on the cup saying caution, content, it's hot. Well, obviously the coffee is going to be hot because there's steam coming from it, but still there was a suit that happened based off of that. So that's a part of the reason why limited liability happens, is to prevent from organizations, companies, businesses, really getting involved personally with the faults of another person because of the product, the use of the product, or how their product was, received. Okay? All right. So I'm going to go over to franchising. I think the book discusses franchising pretty well, but basically what a franchise is, it's a company that you purchase, based on a certain amount of money that the major company allows you to have a piece of. But you still have to operate and do business just like that company would do for that particular franchise, because you're representing them, because you're buying a piece of that company. But there is some leeway with what you can and can't do. So, for example, if you bought a Wendy's franchise and you decided that, you weren't going to offer croutons on your salads or something like that, you can do that. But first you have to get confirmation from the main company to ensure that as a franchise that you can not serve a certain thing that, maybe other Wendy's that aren't franchises normally serve. So it's really important that you understand when buying a franchise, you're not just buying the franchise per se, you're buying a piece of that company, because you're going to make profit based on the fact that, your company, your franchise is that particular name. Okay. All right. Some advantages of franchising is you have less risk because the company is already established. So normally it's a popular name. The training and support is always there. So you can always call headquarters and get advice, get training, get more information. The brand is recognized. If your brand is recognized and you buy a franchise of, a Chipotle or Starbucks, I don't even know if you could buy a Starbucks franchise, but a Chipotle, Starbucks, Burger King, McDonald's, the name is already established. So all you have to do is set up shop and operate, your business. It's easier access to funding because bankers understand the need for branding and marketing and advertising. If you purchase a franchise and it already has the brand and already has the name, then you're pretty golden as far as the bankers go with, getting small business loans to, do marketing, do advertising, bring a new product in that maybe you may not have access to in your particular area. And a lot of times franchises offer more things than the regular store. So like, for instance, I was driving cross country and from California to Florida, and in California, all of the, Taco Bells only offered the standard menu. But we stopped in, Arizona, and because of the culture of the area, we were offered a special menu because of what is normally purchased by local people there. And it was really interesting, and I asked, and, you're able to ask too in your community and say, hey, is this a franchise or is this a non-franchise? And a lot of them, they'll be very honest with you and say, yeah, this is a franchise, and then you can start to network. It's a really awesome way to learn your community, get out, talk, chat, and you never know, they may even have, job opportunities or training opportunities or even networking opportunities for you as well. All right. So some negative, some disadvantages of a franchise is the cost. So more than likely, a franchise is going to cost well into either the 4, 5, maybe even 6 digits. It depends on the franchise that you want to buy. You have a lack of control when it comes to what you want to offer, how the uniforms look, what the processes are, the regulations, the rules, the codes, all that comes along with the franchise. Okay. You have growth challenges. So you can't just be super innovative with a franchise because you have to go at the pace of what the headquarters companies is going to do to a limited degree. All right. All right. And then also restrictions and sales I want to talk about, because it's like I just mentioned about the Taco Bells across the nation. Everybody, can do their own thing, but to a certain extent. All right. All right, so that was pretty much chapter 6, business formalization, choosing the form that fits you. I am Dr. J, and I am here for your success. Have a wonderful day.